Hey, good morning, everybody, and welcome to your second lesson. So today we'll be continuing with your the rest of chapter one, and we saw learning objective one in the previous video, and today we're gonna talk about different kinds of business entities. So typically you have three kinds of business entities, if you could call it. And I'll just go straight to the slide. So there's the idea of sole proprietorship, a partnership, and a corporation, right? So sole proprietorship is when you start your own business. This could be something as simple as a lemonade stand, owning your own restaurant, owning your own hot dog stand. And then you go on to hey, you have one or two business partners and a small group of individuals. You try and form some sort of partnerships. That's the next kind of organization, just slightly bigger in the most usual cases. And then finally comes the corporation. So corporations, you have multiple people owning the business, and this could include anywhere between 10 or 20 to all the way up to I don't know, hundreds of thousands or millions of people, right? So the main idea is between sole proprietorship and partnership are you are the owner. You are the owner, the founder, and typically you're the business. You're the CEO, you're the CFO. And so your incentives are in some sense very well aligned. Hey, if you get rich, or if the business gets rich, you get rich. So you want to do as best as you can in some sense. And sole proprietorship. In a corporation, it's not necessarily the case. So you could get some sort of outside CEO. So in case of Facebook and Tesla, and in many of these big corporations, they still have the founder, the person who founded the firm, is still the CEO. There's so many firms where the founder is not the CEO. There's multiple different, right now Apple, right? It's not Steve Jobs who founded the firm; it's Tim Cook. He still came from within the firm, but in many scenarios, the CEO can be brought on from outside the firm. Let's take an example of BlackBerry, which is a Canadian corporation. So they hired a person who was previously the CEO, I believe, of SAP and Oracle, or some kind of another software engineering firm. I'm not sure. His name is John Chen, and he was brought in from the US, and he's the CEO of BlackBerry right now. And so he was not working for BlackBerry. He has never worked for BlackBerry before. And so they hired the CEO. So in this scenario, but BlackBerry is owned by multiple shareholders, but John Chen owns only a small part of his firm, right? So I'm not saying anything about John Chen, but in certain scenarios, the incentives are not always aligned. John Chen can get a very favorable contract, and certain executive actions can make him better off, but not necessarily make the shareholders better off. A better example might be Bombardier, right? The firm has been mismanaged in multiple ways, but still the family might be better off by retaining control. That's not necessarily good for all the shareholders. Okay. So this is a big difference in terms of ownership and control between an individual business like a dentist or a real estate business or a restaurant business where you're the sole owner, or just two of you are the owners together, and the other one is the corporation where the person, the CEO, is very separate from the shareholders. Okay. Another big difference between these firms is the idea of liability. Right? Let's say in a restaurant, you have some sort of unlimited liability. Let's say you serve some sort of food which had bacteria and poison and had health concerns in your restaurant, and there you could get sued. If your customers die, your restaurant's immediately shut down. They could go after your personal property in most scenarios in order to pay for compensation for those families. Right? In a partnership, there's two kinds of liabilities. There's a general where you could still get unlimited liability, and there's some sort of limited liability. Sometimes you could form limited liability partnerships where you're not really, they cannot go after your house and your personal wealth and your car in order to pay for the expenses. But the corporations typically tend to have limited liabilities, right? So imagine you're a shareholder. You might not even know you're a shareholder. Your work, like my pension fund or something automatically a portion of my income goes towards my retirement, and there'll be a fund which manages that, and they own some shares of British Petroleum, right? And imagine suddenly British Petroleum leaks a bunch of oil, some oil wells leak, and they have some sort of explosions. And all the way, just because I own 10 shares, they cannot come after my personal property, right? So this is the idea of limited liability. Just because I'm a shareholder in British Petroleum does not mean those who are affected by British Petroleum's actions or fraud or whatever it is, they cannot come after each and every individual shareholder's personal property. This is an idea, this is also known as LLCs, limited liability corporations. Okay, so, oh, thought it was connected. Hold on. 1 second. I'm not sure why it's not connecting. Hold on, I'll hold on to this. I'll move on to the next lesson. This part. Okay, so these are the three kinds of, in some sense, business organizations, which are the most common. And for corporations, you typically have some sort of, again, we talked about this separation of ownership and control, where the owners are shareholders, but the CEO is one who controls the decisions. Okay, and also corporations, because the CEO is doing his actions, it has something called the board of directors, where let's see if we connect it. It's better to. Not sure. Okay, I'm having some trouble connecting to my tablet to the computer. So the bunch of shareholders, in some sense, usually elect the board of directors. Okay, and these board of directors are representatives of all the shareholders, and the CEO tends to answer to them. So if you have watched the TV show Silicon Valley, so the Gavin Belson, who is the CEO of the made-up Hooli Corporation, he answers to the board of directors. He always sits in a meeting, and the board of directors question his decision. And they have the right to fire the CEO and also to hire new CEOs. And they always, and in certain big decisions, the board of directors have to approve big decisions by the CEOs. Typically, they're aligned, and the board of directors so is the representative of shareholders. Okay, and corporations are also taxed twice, whereas this is not necessarily the case for sole proprietorship and partnerships, right? So, what is the idea of double taxation, right? So, double taxation is typically when you earn income, you get taxed. That's how a salary system works. You pay a federal level tax and then you pay a provincial level tax. Both are combined together, single tax, but you get taxed only once. The federal and provincial level or municipal level are just different systems of taxation, but they're not taxing you again and again, or not on the same income. Whereas here, when we talk about double taxation for corporations, so let's say corporations earn a revenue, and then like a typical, this is like a typical income statement, right? Like a very simplified income statement. Again, go back to your accounting class. If you took it at Huron, probably with Vicky Sweeney. So this is a typical income statement, and you have revenue, you have cost of goods, or cost of revenue, some sort of gross profit, and you pay some interest, depreciation, and finally you come after this earnings before taxes. You pay taxes to the government, and which in Canada I believe is around 15%. For most firms, and then after you pay taxes, you have some sort of like net earnings. Let's say that's like $100,000 or $100 million. But this is your final net earnings in terms of all of these $100,000. Let's say the earnings before taxes was let's make this 100 million. and here you would have paid 15 million in taxes, and your final net income is $85 million. And out of these $85 million, $100 million in overall earnings, the government took 15 million, and you're left with 85. But now, this net income, this $85 million, assuming it's all cash, sits within the firm. And out of these $85 million, it could reinvest, it could keep the cash within the firm, or in some scenarios, if it has enough cash, it could return a portion of that income back to shareholders in some sort of dividends. In this scenario, let's say it paid $50 million as dividends. Okay? So all of these $50 million which you receive as dividends, and now that this goes from the bank account of the firm to your personal bank account, this $50 million is split between various shareholders. And let's say if I own 10% of the firm, and I will be receiving me. If I own 10% of the firm, I'll be receiving 10% of the dividends. Okay, so I'll be receiving $5 million from this firm. But from this $5 million, the government is going to tax me again at another dividend tax rate of maybe another 15%. Okay, and so this would be 15% of $5 million. So I'll have to pay another 15% of this one, and I'll be left with only $4.25 million. So you're getting taxed once at the what you call corporate level, and then once at a personal level. So this is a typical feature of corporations where they get taxed at multiple levels. And this is one areas where typically on the conservative side, conservative parties in Canada or in US or in Europe, they typically tend to view this like, why are we getting taxed twice? Because you've already been taxed once, and we should reduce tax rates on either on the corporate side or on the personal side if it's already been taxed, right? So that's a good argument in thought, but in practice, a lot of these corporations might not pay that much, and a lot of them have special treaties, and there's so many tax loopholes where in practice, they do avoid one of these either way, and getting rid of another one would make that tax even lesser. So this is another problem where in theory it makes sense, but sometimes in practice it cannot. It does not really. So this will be your net dividend received, and this is the concept of being taxed twice. Okay, so again, this is just the first chapter, and that's your learning objective previous. And then you have this financial manager is anyone who's responsible for managing the money, especially with relates to investment or financing decisions. And there's different levels within them, right? Like you have a CFO, you have treasurer, controller, someone who manages short-term working capital and all these. And finally, we get to a goals of corporation. A goal of any firm should be to make money, right? If you're trying to be, you want to help the world and make the world a better, greener, shinier place, then you're a nonprofit, right? You go start a nonprofit company. But if you're a corporation, but you're getting public shareholders, then the goal of that firm is typically to maximize the value of the firm. Okay, because if you maximize the market value, then it increases shareholder wealth. And look at this third point: maximizing the profit for a particular year or a particular quarter does not necessarily mean maximizing overall market value, right? So, let's say you have some proprietary technology, you could sell a bunch of proprietary technology to some rival company and make billions and billions of dollars in profit this year. You have made more profit than you would have made without that. But in the future years, you might get rid of them, or you could cut corners in some sense. Like Tim Hortons maybe is probably an example where Tim Hortons was associated with feel good and a lot of rural Canada. It was associated with all those hockey towns and carrying that red cup to the hockey rink, right? So, and Tim Hortons did sponsor a lot of local hockey tournaments. So all the people in those areas who were in love with hockey associated themselves, they looked upon Tim Hortons in a more fondling on it in a nicer way. They looked at Tim Hortons in a good way. But now, and after they had merged with its American corporation, they did cut back on some of these charity programs and local hockey programs that they did not sponsor. And a lot of these people, they had a bad Tim Hortons received a lot of flack for canceling a bunch of these programs to the point where there's some sort of public backlash to go for other local chains rather than go to Tim Hortons. And so this was a big problem. So in the short term, sure, you reduce some expenses by not donating money, but these are kind of bringing in money in other ways, and it hurt the brand value of Tim Hortons, which might take years to recover. Okay, so maximizing profit does not necessarily mean in 1 year does not mean increasing the market value. So the objective should be to maximize the current market value. That means maximizing profits today, tomorrow, the day after, year, 5 years from now, 10 years from now, and in a very consistent way. And you have to try and look for the long-term future and not necessarily just sell off a bunch of assets or cut a bunch of expenses. Right? If you fire a bunch of employees and maybe that your company earns a bad reputation, no good employee might want to join your firm in the future. So that's also hurting market value. Okay, so that should be a goal of a corporation. Most firms also, for corporations, if you try and think about it, since you have separate CEOs and separate shareholders, this arises to conflict. Right? We talked a little bit about this before. And this is called the agency problem, right? So let's say the CEO wants like a new private jet, right? Like this is a small firm, it had some money, but it did not have private jet. Or if he wants to travel from Toronto, it's owner of a small firm, CEO of a small firm, wants to travel to New York for some conference, refuses to travel business class and wants to get a private jet. And these sort of expenses, the CEO gains the benefit of the private jet, but the people who are paying the expenses are the shareholders because they are the owners in some sense. So these sort of create some sort of conflicts of interest. So that's the first point, which I talked about, unnecessary expenses. The second problem is they could engage in empire building, like you just buy bigger and bigger other corporations, which might not necessarily make sense. This was a much bigger problem in the 1980s. And this might not necessarily bring about, like, for example, there's a firm called, I think, RJR Nabisco, and they were a tobacco company, and they also owned Oreo cookies. And Oreo is owned by Kraft now, if I remember right. But tobacco company and Oreo cookies, they have no synergy, and it's just boasting rights for the CEO that he's like. The other option is they may shy away from attractive but risky projects, right? It's like at the end of the day, the CEO has to take some risk, innovate, expand in certain areas, try and compete really well. The other option is if the firm is doing well, the CEO can just sit on the chair and coast, not really do anything, collect a fat salary check, and not do much. Whereas the shareholders want the CEO to actually work for them, not just sit and cruise and not work for them. So these are some big agency problems which can be found in operations. So always solutions which tries to mitigate these problems, which we'll be learning in certain other. But these are some problems which can arise especially in public corporations. And the rest of that's it for pretty much for chapter 1. It gives you a list of careers in finance, which I'm not going to talk about. And this is a nice summary. This is the slide. Just to recap, your textbook is Brealey Myers and the Fundamentals of Corporate Finance, and we'll be looking at this chapter. We'll be looking at this textbook, chapters 1 to 13 for this course. Okay, and as always, all right, have a good day. Bye-bye.